Jumpstart Your Wealth, A Beginner's Guide to the Stock Market. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. In the intricate dance of finance, the stock market often appears as an elite arena reserved for the economic gurus and financial wizards. Yet, what if I told you that within this perceived complexity lies a golden pathway to your financial empowerment? This book, Jumpstart Your Wealth, A Beginner's Guide to the Stock Market, is crafted to transform your perspective from viewing stock market investing as a daunting challenge to seeing it as an accessible, practical, and crucial tool for building your wealth. Stock market investments are no longer just for those with finance degrees or insider knowledge. It's for anyone who dreams of financial freedom, wishes to take control of their financial future, and is eager to learn the rhythms of economic tides. This book is your invitation to step into investing with confidence and clarity. We will unravel the essential concepts you need to begin your investment journey through clear, concise, and jargon-free language. From understanding what stocks are and how the market functions to mastering investment strategies and managing risks, every chapter is designed to build on the previous, ensuring you gain comprehensive knowledge to make informed decisions. Moreover, this isn't just about investing, it's about transforming your financial mindset. We'll explore how the discipline of stock market investing can sharpen your decision-making skills, teach you the virtues of patience and resilience, and instill a habit of analytical thinking and valuable qualities in all areas of life. Prepare to challenge your assumptions, ignite your curiosity, and equip yourself with the tools you need for your financial journey. The stock market is not a game of chance but a field of strategic decisions, and with the proper knowledge you can play to win. Let's embark on this transformative journey together, building not just wealth but a profound understanding of how to grow and protect it in the stock market's swirling dynamics. Welcome to your first step towards becoming a savvy investor. Join our vibrant community of seekers and learners by subscribing to the channel. Every subscription is a token of encouragement that fuels our ability to bring you more captivating and thought-provoking content. Subscribe, comment, and like. Become part of the movement shaping the future of learning and growth. In the comments, please let us know what type of books you would like to read. Your feedback helps us tailor our content to better serve you. Let's begin. Chapter 1. What is the stock market? The stock market often conjures images of chaotic trading floors, complex graphs, and high stakes, an exciting and intimidating world. Yet, at its core, the stock market is simply a place where pieces of companies are bought and sold. It is where everyday individuals can become stakeholders in some of the world's most giant corporations, participating in their growth and, in turn, growing their wealth. This chapter demystifies the basic structure of the stock market. We'll start with understanding what stocks are: shares of ownership in a company. When you buy a stock, you buy a piece of that company's future profits and prospects. We'll also cover other essential elements, such as bonds, mutual funds, and exchange-traded funds (ETFs), constituting the stock market's diverse ecosystem. Moreover, we'll explore the role of market indices like the Dow Jones Industrial Average, the S&P 500, and the Nasdaq. These indices provide snapshots of market trends and help investors gauge the health of the economy and the markets. Understanding these indices is crucial as they serve as benchmarks for evaluating individual stocks' performance or your investment strategy's effectiveness. By the end of this chapter, you'll have a foundational understanding of how the stock market works and why it serves as a critical barometer for economic and financial health. This knowledge is not just academic, it's practical and directly applicable to making informed investment decisions. But who ensures that everything in the stock market runs smoothly? In the next chapter, we'll unravel the roles of various market players, from the big institutions to individual traders, and how their interactions shape your investment experience. Chapter 2. Key players in the stock market. The stock market is a complex ecosystem, but it's essential to understand the key players who make it function smoothly. Each participant, from large institutions to individual investors, plays a vital role in maintaining the market's dynamics. First, let's introduce the regulators. Organizations like the Securities and Exchange Commission in the United States ensure that the market operates fairly and transparently. They set and enforce rules to protect investors from fraud and ensure companies provide accurate information. Knowing that regulatory bodies are in place can give you confidence in the market's integrity. Next, we have the brokers. Brokers act as intermediaries between you and the stock market. They provide platforms to buy and sell stocks and offer valuable tools and advice to help you make informed decisions. There are different types of brokers: full-service brokers, who offer personalized advice and services, and discount brokers, who provide the basics at a lower cost. Understanding the role of brokers is crucial, as they are your gateway to the stock market. Traders, both individual and institutional, are also significant players. Individual traders like you participate in the market by buying and selling stocks based on your research and strategies. Institutional traders, such as mutual, hedge, and pension funds, trade in large volumes and can significantly influence market prices. Their activities often create trends that individual investors can leverage. Market makers and specialists are behind-the-scenes players who ensure enough liquidity in the market. They match buyers with sellers and ensure that trades are executed efficiently. This process helps maintain stability and prevents extreme price fluctuations. Don't overlook the importance of financial analysts and the media. They study market trends, company performances, and economic indicators to offer valuable insights and predictions. Their advice and reports have the power to impact investor decisions and market trends. Remember to do your own research and thorough investigation, even when considering their analyses. Understanding these key players and their roles, you'll be better equipped to navigate the stock market and make informed investment decisions. Recognizing the interplay between these participants can also help you anticipate market movements and adjust your strategies accordingly. Now that you know the key players, how do you start participating? In the next chapter, we'll guide you through the essential steps of setting up your investment account so you can take your first step into stock market investing. Chapter 3: Setting up your investment account. Now that you understand the stock market structure and key players, it's time to take the first concrete step: setting up your investment account. This chapter will guide you through the essential steps to ensure you're ready to start investing. First, let's discuss choosing a broker. As mentioned earlier, brokers are your gateway to the stock market. When selecting a broker, consider fees, the range of services offered, the quality of their trading platform, and customer support. Full-service brokers provide personalized advice at a higher cost, while discount brokers offer lower fees but fewer services. Online brokers have become increasingly popular due to their convenience and competitive pricing. Once you've chosen a broker, the next step is to open an account. Most brokers offer various types of accounts, including individual brokerage accounts, joint accounts, retirement accounts like IRAs in the United States, and custodial accounts for minors. Choose the account type that aligns with your investment goals. For instance, a tax-advantaged retirement account might be ideal if you're focused on long-term retirement savings. After selecting the appropriate account type, you must complete the application process. This usually involves providing personal information, including your social security number or equivalent, employment details, financial status, and investment experience. You'll also need to agree to the broker's terms and conditions. Many brokers allow you to complete this process online, making it quick and convenient. With your account set up, the next crucial step is funding it. This typically involves linking a bank account to your brokerage account and transferring funds. Some brokers might have a minimum deposit requirement, so check their terms. It's advisable to start with an amount you're comfortable with, considering that investing involves risk. Before making your first investment, take advantage of your broker's educational resources. Many brokers provide tutorials, webinars, and research tools to help you learn more about investing. If available, familiarize yourself with the trading platform and practice using demo accounts or virtual trading features. Finally, set clear investment goals. Are you looking to build long-term wealth, save for retirement, or generate additional income? Your goals will influence your investment strategy and risk tolerance. Please write down your goals and refer to them regularly to stay focused and disciplined. By the end of this chapter, you should have a fully functional investment account and a clear understanding of how to use it. You're ready to start investing, but what should you buy first? In the next chapter, we'll explore the process of buying your first stocks and making informed investment decisions. With your investment account ready, what's the next step? It's time to learn how to make your first stock purchase and confidently enter the world of trading. Chapter 4: Buying your first stocks. With your investment account set up and funded, you can purchase your first stock. This chapter will guide you through the process, from selecting your first stock to executing the trade, ensuring you make informed decisions every step of the way. Before buying your first stock, it's crucial to do some research. Start by identifying companies that align with your investment goals and values. Look for businesses you understand and believe in. This familiarity can help you make more confident and informed decisions. One essential tool in stock selection is fundamental analysis. This involves evaluating a company's financial health, management, industry position, and growth potential. Critical financial statements to review include the income statement, balance sheet, and cash flow statement. These documents provide insights into the company's revenue, expenses, profitability, assets, liabilities, and cash flow. Metrics such as earnings per share (EPS), price to earnings (PE) ratio, and dividend yield can help you assess whether a stock is fairly valued. Another approach is technical analysis, which focuses on historical price and volume data to predict future stock movements. This method uses charts and indicators, such as moving averages and relative strength index (RSI), to identify trends and potential entry or exit points. While technical analysis can be helpful, it's often used with fundamental analysis for a more comprehensive view. Once you've selected a stock, it's time to place an order. There are different types of orders you can use to buy stocks. Market order. This type of order buys the stock at the current market price. It ensures that your order is executed quickly, but the exact cost may vary due to market fluctuations. Limit order. This order lets you specify the maximum price you will pay for the stock. The order will only be executed if the stock's price exceeds your limit. This provides more control over the purchase price but may take longer to implement. Stop order. A stop order becomes a market order once the stock reaches a specified price, known as the stop price. This type can help protect against significant losses. For your first purchase, a market order might be the simplest and fastest way to get started. Log into your brokerage account, enter the stock's ticker symbol and the number of shares you wish to buy, and select the order type. Double-check all the details before confirming the transaction. After placing your order, monitor the stock to see how it performs. While feeling excited or anxious is natural, remember that investing is a long-term endeavor. Staying patient and avoiding making impulsive decisions based on short-term market fluctuations is essential. As you gain experience and confidence, you can refine your stock selection process and trading strategies. Keep learning, stay informed about market trends and news, and continuously review your investment goals and strategy. Purchasing stocks is just the beginning. How do you ensure your portfolio grows and adapts to market changes? In the next chapter, we'll explore strategies for selecting stocks that align with your financial goals and maximizing your investment potential. Chapter 5. Strategies for selecting stocks. Now that you've made your first stock purchase, it's time to delve deeper into the strategies to help you choose stocks wisely and build a robust portfolio. This chapter focuses on fundamental and technical analysis techniques, empowering you to make informed and strategic investment decisions. Fundamental analysis. Fundamental analysis involves evaluating a company's intrinsic value by examining various financial metrics and economic factors. Here are some key elements to consider. Financial statements. Review the income statement, balance sheet, and cash flow statement. These documents reveal the company's financial health, profitability, and cash flow. Look for consistent revenue growth, healthy profit margins, and manageable debt levels. Earnings per share. EPS indicates the portion of a company's profit allocated to each outstanding share. A rising EPS suggests growing profitability, which can be a positive sign for investors. Price to earnings PE ratio. This ratio compares a company's current share price to earnings per share. A lower PE might indicate the stock is undervalued, while a higher PE could suggest overvaluation. Comparing PE ratios within the same industry can provide context. Dividend yield. Consider stocks with a solid dividend yield if you're looking for income-generating investments. This metric shows how much a company pays out in dividends relative to its share price. Stable or growing dividends often indicate a financially healthy company. Competitive advantage. Evaluate a company's position within its industry. Does it have a strong brand, proprietary technology, or a significant market share? Companies with a sustainable competitive advantage are more likely to succeed long-term. Technical analysis. Technical analysis focuses on historical price and volume data to identify patterns and trends indicating future price movements. Here are some essential tools and indicators. Moving averages. These are average stock prices over specific periods, example, 50-day, 200-day. They help smooth out price data to identify trends. A stock trading above its moving average is generally considered an uptrend. Relative Strength Index. RSI measures the speed and change of price movements. An RSI above 70 indicates that a stock may be overbought, while an RSI below 30 suggests it may be oversold. Support and resistance levels. These are price points where a stock tends to stop and reverse its direction. Support levels indicate where a stock finds buying interest, while resistance levels show where selling pressure emerges. Developing a strategy. Consider combining fundamental and technical analysis to create a successful stock selection strategy. Here's a step-by-step approach. Set clear goals. Define your investment objectives. Are you looking for growth, income, or a balance of both? Your goals will influence the types of stocks you choose. Conduct research. Use fundamental analysis to identify financially healthy companies with strong growth potential. Look for those with solid earnings, competitive advantages, and reasonable valuations. Analyze trends. Apply technical analysis to pinpoint optimal entry and exit points. Utilize moving averages and various indicators to validate upward trends or possible reversals. Diversify your portfolio. Spread your investments across different sectors and industries to reduce risk. Diversification helps protect your portfolio from significant losses if one sector underperforms. Monitor and adjust. Review your portfolio regularly and adjust your holdings based on performance and changing market conditions. Stay informed about market news and trends to make proactive decisions. By the end of this chapter, you'll have a comprehensive understanding of strategically selecting stocks. Combining these methods will help you build a balanced and resilient portfolio, setting the stage for long-term success. After choosing your stocks, how do you manage your portfolio to maximize returns and minimize risks? The next chapter will explore effective portfolio management strategies to help you achieve your financial goals. Chapter 6. Managing your investment portfolio. Investing in individual stocks is the beginning of your journey toward building wealth. The next crucial step is managing your investment portfolio effectively. Portfolio management involves monitoring and adjusting your investments to ensure they align with your financial goals, risk tolerance, and market conditions. Diversification. Diversification is a fundamental principle of portfolio management. It involves spreading your investments across various asset classes, industries, and geographic regions to reduce risk. The idea is that different investments will perform differently under the same economic conditions to protect a diversified portfolio against significant losses. Asset classes. Diversify your portfolio by including a mix of stocks, bonds, mutual funds, ETFs, and possibly real estate or other alternative investments. Each asset class has different risk and return characteristics. Industries. The industry invest in companies from various sectors, such as technology, healthcare, finance, and consumer goods. This strategy helps mitigate the risk associated with sector-specific downturns. Geographic regions. Consider international investments to take advantage of growth opportunities in different parts of the world. Global diversification can reduce the impact of regional economic fluctuations. Risk assessment. Understanding and managing risk is essential for successful portfolio management. Here are some key strategies. Risk tolerance. With market fluctuations, assess your risk tolerance based on your investment goals, time horizon, and personal comfort level. This assessment will guide your asset allocation decisions. Regular rebalancing. Over time, some investments will grow faster than others, causing your portfolio to drift from its target allocation. Regularly rebalance your portfolio by buying or selling assets to maintain your desired risk level. Stop-loss orders. Use stop-loss orders to limit potential losses on individual stocks. A stop-loss order automatically sells a stock when it reaches a predetermined price, protecting you from significant downturns. Performance monitoring. continuous monitoring of your portfolio's performance is crucial. Here's how to stay on top of your investments. Track metrics. Regularly review key performance metrics, such as overall return, individual stock performance, and asset allocation. Many brokerage platforms offer tools and reports to help you track these metrics. Stay informed. Keep up with market news, economic indicators, and company-specific developments. Staying informed will help you make timely and informed decisions. Fine-tune your plans. Make sure to adapt your investment strategies according to shifts in the market and your own financial objectives. Being flexible is key to effectively managing your portfolio. Long-term perspective. Maintaining a long-term perspective is vital in portfolio management. While short-term market fluctuations can be unsettling, focusing on your long-term goals will help you stay committed to your investment strategy. Avoid emotional decisions. Emotions like fear and greed can lead to impulsive decisions that harm your portfolio. Stick to your investment plan and avoid reacting to short-term market movements. Compounding growth. Take advantage of the power of compounding by reinvesting dividends and capital gains. Over time, compounding can significantly enhance your portfolio's growth. Review goals. Review and update your financial goals regularly. Life circumstances change, and your investment strategy should evolve to meet new objectives. By the end of this chapter, you'll clearly understand how to manage your investment portfolio effectively. Implementing these strategies will help you maximize returns, minimize risks, and stay on track to achieve your financial goals. Understanding the risks involved in stock market investing is as crucial as managing them. In the next chapter, we'll uncover the everyday risks you may encounter and how to mitigate them effectively. Chapter 7. Understanding and mitigating risks. Investing in the stock market offers significant wealth-building potential but comes with risks. Understanding these risks and mitigating them is crucial for long-term investment success. This chapter delves into the various types of investment risks and practical steps to manage them. Types of investment risks. Market risk. This is the risk of losing value due to overall market declines. Factors such as economic downturns, political instability, and global events can cause stock prices to drop worldwide. Company-specific risk. Also known as unsystematic risk, it pertains to risks specific to an individual company, such as poor management, product recalls, or regulatory issues. Liquidity risk. This risk arises when an investor cannot buy or sell assets quickly without affecting the asset's price. Stocks with low trading volumes can be challenging to sell promptly at a fair price. Interest rate risk. Changes in interest rates can affect the value of investments, particularly bonds. Rising interest rates often lead to falling bond prices and can impact stock prices. Inflation risk. This is the risk that inflation will erode the purchasing power of your investment returns. If your portfolio doesn't grow at a rate that outpaces inflation, your actual returns will diminish over time. Currency risk. Exchange rate changes can affect the value of international investments. Currency fluctuations can lead to gains or losses independent of the asset's performance. Mitigating investment risks. Diversification. As discussed in the previous chapter, diversifying your portfolio across different asset classes, industries, and geographic regions can significantly reduce risk. Diversification helps ensure that the poor performance of one investment doesn't heavily impact your overall portfolio. Asset allocation. Allocate your investments based on your risk tolerance, time horizon, and financial goals. A well-balanced mix of stocks, bonds, and other assets can provide stability and growth potential. Revisit and adjust your asset allocation periodically to stay aligned with your objectives. Research and due diligence. Conduct thorough research before investing in any stock. Understand the company's business model, financial health, competitive position, and growth prospects. Staying informed reduces the likelihood of investing in high-risk or underperforming assets. Risk management tools. Utilize stop-loss orders and limit orders to protect your investments. Stop-loss orders automatically sell a stock when its price falls to a predetermined level, helping to prevent significant losses. Limit orders ensure you buy or sell stocks at specific prices, providing more control over your trades. Hedging strategies. Consider hedging techniques to protect your portfolio. Options, futures, and other derivatives can be used to hedge against potential losses. While hedging can reduce risk, it also comes with costs and complexities, so it's essential to understand these strategies fully. Stay updated. Review your investments regularly and stay informed about market conditions. Monitor economic indicators, financial news, and company updates to anticipate potential risks. Being proactive allows you to make timely adjustments to your portfolio. Long-term perspective. Maintain a long-term investment horizon to weather short-term market volatility. Focus on your financial goals and avoid making impulsive decisions based on market fluctuations. Historically, the stock market has shown resilience and growth over the long term. Professional advice. If you're unsure about managing risks, consider seeking advice from a financial advisor. Professionals can provide personalized guidance based on your financial situation and investment goals. Understanding the various risks and implementing these mitigation strategies will better equip you to protect your portfolio and achieve your financial objectives. Managing risks effectively is a cornerstone of successful investing. Now that you understand the risks and how to manage them, how can you capitalize on market trends and opportunities? The next chapter will explore advanced investment strategies to enhance your portfolio's growth potential. Chapter 8. Advanced Investment Strategies. With a solid foundation in place, it's time to explore more advanced investment strategies that can help you maximize your returns. Experienced investors typically use these strategies to capitalize on market opportunities and manage risks more effectively. Short selling. Short selling involves borrowing shares of a stock you believe will decrease in value, selling them at the current market price, and then repurchasing them at a lower price to return to the lender. The difference between the selling price and the repurchase price is your profit. However, short selling is risky because you could face significant losses if the stock price rises instead of falling. It's crucial to have a strong understanding of market trends and to use stop-loss orders to manage potential losses. Options trading. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified time frame. There are two main types of options. Call options. These give you the right to buy a stock at a specific price. Investors use call options when they expect the stock price to rise. Put options. These give you the right to sell a stock at a specific price. Investors use put options when they expect the stock price to fall. Options can be used for hedging, protecting your portfolio against potential losses, or speculative purposes, betting on the future direction of stock prices. While options can offer significant profits, they also come with high risks, so it's essential to understand the mechanics and strategies before investing. Exchange-traded funds. ETFs are investment funds that trade on stock exchanges, much like individual stocks. They typically track an index, a commodity, or a basket of assets. ETFs offer diversification, lower fees, and ease of trading. Advanced strategies involving ETFs include leveraged ETFs. These aim to provide a multiple of the underlying index's return, example, 2x or 3x. They are used for short-term trading and can amplify gains but also increase the potential for losses. Inverse ETFs. These aim to provide the opposite return of the underlying index. They are used for hedging or profiting from declining markets. Dividend reinvestment plans. DRIPs allow you to reinvest dividends received from a stock back into additional shares of the same stock, often without paying a commission. This strategy leverages the power of compounding, enabling your investment to grow faster over time. DRIPs are ideal for long-term investors who want to maximize their returns through continuous reinvestment. Dollar cost averaging. Dollar cost averaging involves regularly investing a fixed amount of money into a particular stock or fund, regardless of its price. This strategy reduces the impact of market volatility by spreading your investments over time. It ensures that you buy more when prices are low and fewer when prices are high, potentially lowering your average cost per share. Value investing. Value investing focuses on buying stocks that appear to be undervalued based on fundamental analysis. Value investors look for companies with robust financial health, stable earnings, and a competitive advantage, but whose stock prices are lower than their intrinsic value. This strategy requires patience and a long-term perspective, as it may take time for the market to recognize the actual value of these stocks. Growth investing. Growth investing targets companies with high potential for future growth, often characterized by rapid revenue and earnings increases. Growth stocks tend to trade at higher valuations due to their potential for significant capital appreciation. This strategy involves identifying companies in emerging industries, such as technology or biotechnology, poised for substantial growth. Sector rotation. Sector rotation involves shifting investments between different economic sectors based on economic cycles. For example, cyclical sectors like technology and consumer discretionary tend to perform well during economic expansions, while defensive sectors like utilities and healthcare may outperform during downturns. This strategy requires a keen understanding of financial indicators and market trends. Incorporating these advanced strategies into your investment approach can enhance your portfolio's growth potential and better navigate market fluctuations. However, to mitigate risks, it's important to thoroughly research and understand each strategy before implementation. With advanced strategies in place, how do you monitor your investment's performance? The next chapter will examine the essential tools and techniques for monitoring your investments and ensuring they align with your financial goals. Chapter 9. Monitoring your investments. Investing is not a set-it-and-forget-it endeavor. Regularly monitoring your investments is crucial to ensure that your portfolio remains aligned with your financial goals and adapts to changing market conditions. This chapter will provide the tools and techniques for effective portfolio monitoring. Tracking performance metrics. Overall return. Calculate your portfolio's total return, including capital gains, dividends, and interest. This metric gives you a clear picture of how well your investments are performing over time. Individual stock performance. Evaluate how each stock in your portfolio is doing by comparing their returns to market indices or sector averages to see how they stack up. Asset allocation. Make sure to regularly review your asset allocation to make sure it matches your investment strategy and risk tolerance. Market changes can lead to your portfolio drifting from its intended allocation, so adjustments may be needed. Risk assessment. Monitor your investment's risk levels. Tools like the Sharpe ratio beta and standard deviation can help you understand your portfolio's risk-adjusted returns. Using technology and tools. Brokerage platforms. Most brokerage platforms offer robust tools for tracking and analyzing your portfolio. Utilize their performance reports, charts, and alerts to stay informed. Financial apps. Consider using financial apps that provide real-time updates, news, and analysis. Apps like Yahoo Finance, Bloomberg, and Morningstar can offer valuable insights and tracking capabilities. Spreadsheet software. If you prefer a more hands-on approach, create a custom spreadsheet to track your investments. Include columns for purchase price, current price, dividends, and total return. Regularly update your spreadsheet to reflect your portfolio's performance accurately. Staying informed. Market news. Keep up with financial news and market trends. Understanding the broader economic context can help you anticipate market movements and make informed decisions. Company updates. Follow your invested companies by reading their earnings reports, press releases, and analyst reviews. Staying informed about company-specific developments can alert you to potential risks or opportunities. Economic indicators. Monitor vital economic indicators like GDP growth, unemployment rates, and inflation. These indicators can provide insights into the overall economic environment and potential impacts on your investments. Adjusting your portfolio. Rebalancing. Periodically rebalance your portfolio to maintain your desired asset allocation. Rebalancing involves buying or selling assets to restore your portfolio to its target mix. This process helps manage risk and ensures that your investments align with your goals. Performance-based adjustments. If certain investments consistently underperform or no longer align with your strategy, consider replacing them with better-performing assets. Conversely, if an investment is doing exceptionally well, review whether it still fits within your risk tolerance and goals. Tax considerations. Be mindful of the tax implications of buying and selling investments. Tax loss harvesting involves selling losing investments to offset gains and can help minimize your tax liability. Additionally, holding investments for more extended periods can qualify you for lower long-term capital gains tax rates. Long-term focus. Avoiding emotional decisions, market volatility can tempt investors to make impulsive decisions. Maintain a long-term perspective and avoid reacting to short-term market fluctuations. Stick to your investment plan and remain disciplined. Reviewing goals. Regularly revisit your financial goals to ensure they are still relevant and achievable. Life circumstances can change, and your investment strategy should evolve accordingly. Continuous learning. Investing is a lifelong learning process. Stay curious and continue educating yourself about market trends, investment strategies, and financial planning. Knowledge is a powerful tool that can help you make better investment decisions. By implementing these monitoring strategies, you can stay informed about your portfolio's performance and make necessary adjustments to achieve your financial goals. Effective monitoring ensures that your investments remain on track and adapt to changing market conditions. Investment is not just about making money, it's also about making smart tax decisions. In the upcoming chapter, we'll explore how to manage your assets for tax efficiency and maximize your after-tax returns. Chapter 10. Tax considerations in investing. Investing is not just about generating returns, it's also about keeping as much of those returns as possible. Understanding and managing the tax implications of your investments can significantly impact your overall profitability. This chapter will explore strategies to optimize your assets for tax efficiency. Types of investment taxes. Capital gains tax. This tax is levied on the profit from the sale of an asset. There are two types. Short-term capital gains. Gains from assets held for 1 year or less are taxed at your ordinary income tax rate. Long-term capital gains. Gains from assets held for more than 1 year are taxed at a lower rate, which can be 0%, 15%, or 20%, depending on your income level. Dividend tax. Qualified dividends are taxed at the long-term capital gains rate, while non-qualified dividends are taxed at your ordinary income tax rate. Interest income tax. Interest earned from savings accounts, bonds, and other interest-bearing investments is taxed at your ordinary income tax rate. Tax-efficient investment strategies. Hold investments long-term. One of the most straightforward strategies to minimize taxes is holding your investments for over a year. This way, any gains will be subject to the lower long-term capital gains tax rate. Tax-advantaged accounts. Utilize tax-advantaged accounts such as IRAs, 401ks, and Roth IRAs to defer or eliminate taxes on your investment gains. Traditional IRA, 401k. Contributions may be tax-deductible, and investments grow tax-deferred until withdrawal, at which point they are taxed as ordinary income. Roth IRA, 401k. Contributions are made with after-tax dollars, but withdrawals are tax-free if certain conditions are met, making it an excellent choice for long-term growth. Tax loss harvesting. Offset gains by selling investments that have declined in value to realize a loss. These losses can be used to offset taxable profits, and if losses exceed gains, up to $3,000 can be deducted from your ordinary income each year, with excess losses carried forward to future years. Asset location. Strategically place investments in the most tax-efficient accounts. Tax-deferred accounts. Place interest-bearing investments, actively managed funds, and high-dividend stocks in tax-deferred accounts to avoid taxes on income and gains until withdrawal. Taxable accounts. Hold tax-efficient investments like individual stocks held long-term and tax-managed funds in taxable accounts. Municipal bonds. Consider investing in municipal bonds, which are often exempt from federal and, in some cases, state and local taxes. These bonds can be an attractive option for generating tax-free income. Year-end tax planning. Review your portfolio. At the end of each year, review your portfolio to identify opportunities for tax loss harvesting and rebalancing. Ensure that your actions align with your overall investment strategy and financial goals. Consider capital gains distributions. Mutual funds and ETFs often distribute capital gains to shareholders. Be mindful of these distributions and their timing, as they can affect your tax liability. Maximize contributions. Ensure you are maximizing contributions to tax-advantaged accounts each year. Contributions to IRAs and 401ks can reduce your taxable income and provide tax-deferred or tax-free growth. Estate planning considerations. Step up in basis. When you inherit assets, the cost basis is typically stepped up to the asset's fair market value at the time of the original owner's death. This can significantly reduce capital gains taxes on inherited assets. Gifting. Consider gifting appreciated assets to family members in lower tax brackets. This can reduce the overall tax burden and facilitate wealth transfer within the family. Trusts and estate planning tools. Utilize trusts and other estate planning tools to manage the tax implications of transferring wealth. Trusts can provide control over asset distribution and potential tax benefits. By implementing these tax-efficient strategies, you can minimize your tax liability and maximize your after-tax returns, allowing more investment gains to contribute to your financial goals. Effective tax planning is an integral part of a successful investment strategy. As we approach the end of this chapter, what mindset should you adopt to become a successful investor? The next chapter will discuss the psychological aspects of investing and strategies for maintaining a disciplined approach to achieve long-term success. Chapter 11. The Investor's Mindset. Successful investing is as much about mindset and psychology as it is about strategy and analysis. The right mindset can help you navigate market volatility, resist impulsive decisions, and stay committed to your long-term financial goals. This chapter explores the psychological aspects of investing and provides strategies for maintaining a disciplined and resilient approach. Emotional discipline. Avoiding emotional reactions. Emotions like fear and greed can lead to impulsive decisions that undermine your investment strategy. Market downturns may tempt you to sell investments in a panic, while euphoric market highs might encourage reckless buying. Recognize these emotional triggers and commit to sticking to your plan. Staying calm during volatility. Market volatility is a natural part of investing. Understanding that normal fluctuations can help you remain calm and avoid knee-jerk reactions. Focus on your long-term goals and remember that the market has historically rebounded from downturns. Developing patience. Long-term perspective. Adopting a long-term perspective is crucial for investment success. Instead of fixating on daily price movements, focus on the overall trend and your long-term objectives. Patience allows you to benefit from the power of compounding and reduces the stress associated with short-term market noise. Understanding market cycles. Markets go through cycles of growth and contraction. Understanding these cycles allows you to anticipate changes better and make informed decisions. Patience during market downturns can lead to substantial gains when markets recover. Building resilience. Learning from mistakes. Every investor makes mistakes. Instead of being discouraged, view mistakes as learning opportunities. Analyze what went wrong, adjust your strategy if necessary, and apply these lessons to future investments. Or diversification as a buffer. Diversification reduces risk and builds resilience. A well-diversified portfolio can withstand individual investment losses without derailing your financial plan. Maintaining consistency. Regular investing and consistency are crucial to building wealth over time. Regularly contribute to your investment accounts, regardless of market conditions. As discussed earlier, dollar cost averaging helps mitigate the impact of market volatility. Revisiting goals. Periodically review your financial goals and investment strategy. Life circumstances and market conditions change, so it's essential to adjust your plan accordingly. Regular reviews ensure that you stay on track and aligned with your objectives. Continuous learning. Staying informed. The investment landscape is constantly evolving. Stay informed about market trends, economic indicators, and new investment opportunities. Continuous learning helps you adapt to changes and make better informed decisions. To expand your knowledge, consider reading books, participating in seminars, and keeping up with reliable financial news sources. Exploring different viewpoints can help you gain a deeper understanding and learn about effective investment strategies. Behavioral finance insights. Overcoming biases. Recognize and address common cognitive biases that can affect your investment decisions. Confirmation bias, which favors information that confirms your beliefs. Loss aversion, which causes fear of losses. And recency bias, which overemphasizes recent events, are some examples. Being aware of these biases can help you make more rational choices. Mindful decision making. Practice mindfulness to stay present and focused. Mindful decision making involves being aware of your thoughts and emotions, allowing you to make more deliberate and thoughtful investment decisions. Support systems. Mentorship and advice. Seek advice from experienced investors, financial advisors, or mentors. Their insights and guidance can provide valuable perspectives and help you navigate complex investment decisions. Community and accountability. Join investment groups or communities where you can share experiences, discuss strategies, and hold each other accountable. A supportive network can enhance your learning and keep you motivated. By cultivating the right mindset, you can navigate the ups and downs of investing with confidence and resilience. Emotional discipline, patience, and continuous learning are vital attributes that will help you achieve long-term investment success. We've covered a lot, but before you embark on your investment journey, let's recap the key takeaways and provide additional resources to keep you informed. In the final chapter, we'll summarize the essential lessons and offer guidance on furthering your investment knowledge. Chapter 12. Wrapping up and further resources. Congratulations on reaching the final chapter of this book. By now, you should have a solid foundation in stock market investing, equipped with essential knowledge and practical strategies to begin your journey. In this chapter, we'll recap the key takeaways, emphasize the importance of continuous learning, and provide additional resources to help you further your investment knowledge. Recap of key takeaways. Understanding the stock market. You've learned the basic structure of the stock market, including what stocks are, how the market operates, and the significance of market indices. This foundational knowledge is crucial for making informed investment decisions. Key players in the stock market. Familiarize yourself with the roles of regulators, brokers, traders, and market makers. Understanding these participants helps you navigate the market more effectively and make better informed decisions. Setting up your investment account. We discussed the steps to choose a broker, open an account, and fund it. Proper setup ensures you're ready to start investing with confidence. Buying your first stocks. You've learned to research stocks, place orders, and execute your first trade. This initial step is vital for gaining practical experience in the stock market. Strategies for selecting stocks. Combining fundamental and technical analysis allows you to identify and select stocks that align with your financial goals. These strategies provide a comprehensive approach to stock selection. Managing your investment portfolio. Effective portfolio management involves diversification, risk assessment, and regular rebalancing. These practices help protect and grow your investments over time. Understanding and mitigating risks. Recognizing various types of investment risks and implementing mitigation strategies is crucial for long-term success. Managing risks ensures that your portfolio remains resilient and aligned with your goals. Advanced investment strategies. Utilizing advanced strategies such as short selling, trading options, and sector rotation can help enhance the growth of your investment portfolio. These techniques offer experienced investors additional resources to optimize their profits. Monitoring your investments. Regularly tracking performance metrics, staying informed, and adjusting your portfolio are essential to successful investing. Continuous monitoring helps you stay on track and make informed decisions. Tax considerations in investing. Tax-efficient strategies can significantly impact your overall returns. Understanding and managing tax implications is essential for maximizing after-tax returns. The investor's mindset. Cultivating emotional discipline, patience, and a long-term perspective is critical for investment success. The right mindset helps you navigate market volatility and stay committed to your financial goals. Continuous learning. Investing is a lifelong journey. Continuous learning is vital for adapting to changing market conditions and improving your strategies. Here are some ways to further your investment knowledge. Books. Continue reading books on investing, finance, and economics. Some recommended titles include The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, A Random Walk Down Wall Street by Burton G. Malkiel, The Little Book of Common Sense Investing by John C. Bogle. Online courses. Enroll in online courses and webinars to deepen your understanding of investment concepts and strategies. Websites like Coursera, Udemy, and Khan Academy offer courses on finance and investing. Financial news and analysis. Follow reputable financial news sources such as Bloomberg, CNBC, The Wall Street Journal, and Financial Times. Staying updated with market news and analysis helps you make informed decisions. Investment communities. Join investment forums, social media groups, and local investment clubs. Engaging with fellow investors can provide valuable insights, support, and accountability. Podcasts and videos. Listen to investment podcasts and watch educational videos. Platforms like YouTube, Apple Podcasts, and Spotify offer a wealth of content on various investment topics. Additional resources. Free and brokerage tools. Utilize the research tools, reports, and educational resources your brokerage platform provides. These tools can enhance your investment decisions and strategy development. Financial advisors. Consider consulting with a financial advisor for personalized advice and guidance. A professional can help tailor your investment strategy to your unique financial situation and goals. Investment newsletters. Subscribe to investment newsletters for expert analysis, stock recommendations, and market insights. Some popular newsletters include those from Morningstar, Motley Fool, and Seeking Alpha. Government resources. Explore resources provided by government agencies like the Securities and Exchange Commission (SEC) and the Financial Industry Regulatory Authority. These organizations offer educational materials and tools for investors. As you conclude this guide, remember that investing is a continuous journey. Stay curious, keep learning, and remain disciplined in your approach. Your financial goals are within reach, and with the knowledge and strategies you've gained, you're well equipped to navigate the stock market confidently. Thank you for listening. Elevate your learning journey with our channel by subscribing today. Each video we create is designed to challenge, inspire, and enlighten. By subscribing, you ensure you're up to date with the latest content and support our quest to make learning accessible and engaging. Your feedback helps us tailor our content to serve you better. Join the conversation below, and let's learn and grow together. Let's explore the limits of what we can achieve together. Be well and thrive.